It's really spectacular that our keynote speaker is Senator Elizabeth Warren for many, many reasons, but let me start with a very ALI-centric reason. And Lance will say more about this because Lance and Senator Warren worked very closely together as leaders of the ALI for many years. But I want to focus on the Young Scholar Award because that's what we're celebrating, scholarship by people who are about to transition out of being young, like Adam. So there have been 4 awardees. As you know, I mentioned this yesterday, my colleague Oren Bar-Gil, Jeannie Fromer, Adam Levitin, and Amy Monahan. It turns out that Senator Warren was the principal mentor, a very important mentor, to 2 of these 4 award winners. With Oren Bar-Gil, she co-authored an article, Making Credit Safer, which actually created the blueprint for the establishment of the Consumer Financial Protection Bureau. And Adam was one of her students. They testified jointly on the Credit Card Holder Bill of Rights. So she was not only a professor teaching courses that these people took and presumably learned from, but also a hands-on mentor who co-authored articles, who brought them along in her public policy endeavors. And people like that are actually extremely rare in academic life. And I dare say that people like that who then become US senators are, this is a set that includes only one person, Senator Warren. So she is one of us elected to the US Senate. I mean, in case any of you have great ambitions, probably the only one of us who will achieve this goal. But it's wonderful to welcome her here, a person whose own intellectual work has created a path that has been followed by many young scholars and ones who have been honored by the ALI. So I'm delighted. Just speaking autobiographically, my daughter's first vote in Massachusetts was for the senator. She got all her friends to register to do this. My son was an intern at the Consumer Financial Protection Bureau, and feel like I've been a big beneficiary. And for those of us who are around academic institutions, where one of the issues that we really grapple with is student loans and the impact of student loans, the center has been an incredible friend to this issue and supporter of efforts to create some rationality in a system in which it looks like the only interests that go up at a time when interests go down in the economy are interests in student loans. So all of us in academic institutions owe the senator a huge debt of gratitude for bringing attention to this issue and trying to come up with a rational solution that will work, that will be good policy and that will work for the various constituencies. So I wish I could actually give a more formal introduction, but that is the job of my illustrious predecessor, Lance Liebman, and I'll turn the podium over to him. Thanks so much, Senator. Thank you, Lance.
So Ricky has just said basically every word I was going to say, and so I've just tried to think of 1 or 2 tiny things to say instead that were not what I was planning to say. I was planning to say all of that. It's fine, but let me just say my voice is you'll benefit from the fact that I don't have much voice today. That's either a cold or it's the weather in this city. And here's the evidence of why the founding fathers thought this land was not worth being used for anything except the capital city. But let me just say one quick story that I don't believe I've said to Senator Warren before. But at one of the meetings a couple of years ago where the ALI was struggling with the Uniform Law Commissioners about mortgage reform and all of that, a meeting actually at which Adam Levitin was a major and very significant participant, I was saying I didn't think it was quite time to start on that yet. The country was still in crisis and it'd be hard to get things through legislatures, things like that. And so then there was a coffee break and I went over and one of the ULC big shots came over to me, unfortunately a Columbia Law School graduate, and he said, he didn't like what I'd said, and he said, Lance, you're just a pointy-headed intellectual, just like Herb Wexler. And I've always thought, well, that was the best praise that I'd ever gotten in my life. And so what I want to say is that Senator Warren is a pointy-headed intellectual, like Herb Wexler, but way beyond that. And this is what Ricky was correctly saying, in terms of the ways that she has connected serious research, major scholarly work, empirical work, as well as theoretical work, and then somehow connected it as she's moved into the real world in the ways she had. As a little boy, me from Frankfort, Kentucky, I just pause daily to wonder how a little girl from Oklahoma becomes the senior senator from the Commonwealth of Massachusetts. And it is an amazing story and says things about this country, but it also says things about her. And basically, to repeat what Ricky said, I don't know anyone in the academic generation she's in who combining the publication significance, the amazing teaching of generations of students at half a dozen law schools altogether, and now in the real world, and what she did at the agency, and what she's doing now for the country in the Senate. So it's just wonderful that she's here basically to honor Adam, and it ties the whole thing together. Senator Warren was, for some years, on the Council of the American Law Institute. She was the vice president of the American Law Institute. So we don't deserve it, but we take huge credit for that area of her connection of the academic side to the public policy, influence the world side. She's moved on way beyond the ALI, but we are very proud of her. Thank you.
All right. I didn't know for sure. All right. Thank you very much. So thank you. It is a real treat to be here. You know, I appreciate Lance's comment about my being out now in the real world. Only in this room would the United States Senate be referred to as the real world. But it is delightful to be here. It is delightful to be here at the behest of the American Law Institute. As Lance said, it's really a place, the ALI, where I had a chance to cut my teeth on the notion of academics getting together with practicing lawyers and with judges as we tried to hammer out what we thought were the best directions for the law to go, and doing it through the restatements and through the uniform laws really gave an opportunity, for me at least, not only to hear and to learn and to get other perspectives, but actually to drive towards something. That the ultimate goal was not to persuade each other. The ultimate goal was actually to try to do some good. And so it was a wonderful experience, many years with the American Law Institute. It's also fabulous, I really mean this, to look around this room and see the number of people in this room that I've worked with, that I know, and the number of people in this room who do the extraordinary work of trying to develop good, hard academic data, something solid, something that is dependable, something that is truly defensible, and give us some insight into what's really happening, and then try to translate that into possible policy implications. And I look out here and I see Susan, and I see Bob, and I see Melissa, and I see all kinds of people. I'm going to forget all kinds of people once I start down this path. And Pat's terrific book on mortgages. And so lots of work that's done in this room by people who really do understand that all those who want to make fun of academics and all those who want to say, you know, it's just a, you know, sheltered workshop for those who can't make it in the real world. I really do want to say, boy, I think they've really got it backwards. I think people who do serious, rigorous work and try to translate that into policy work, frankly, is just one of the best hopes we've got for the future in getting at least parts of this right. So I'm delighted to have been invited here today to give the opening speech. I think it's the opening speech. This thing is wobbly. Here we go. To give the opening speech and to say thank you very much to Adam Levitin for inviting me here. You know, when Adam was a student in my contract law class, I'm going to now tell the stories, I saw something really exceptional in him. He was smart, sure, but pretty much all the kids in that class were smart. He was hardworking, sure, but pretty much all the kids in that class were hardworking. What made Adam stand out is that he is intellectually fearless. He dived into hard problems with intensity and with energy, and he took on hard ideas as a challenge. When he told me, and I remember when you told me, that he wanted to be a professor, I was genuinely delighted because I believed that Adam would be one of those people who would take advantage of the amazing opportunities that the academic world affords in order to take on the hardest challenges that this country faces. And that meant he would at least have a chance to make some of the biggest contributions. So it is a special delight to be here today at a conference that Adam has organized, it is no surprise, to talk about one of the hardest issues we face, and that is how to adjust a broken housing finance market to make it work, not just for big banks and for wealthy home buyers, but to make it work for millions of families across this country. Now, home ownership remains the centerpiece of the American dream. Everyone says this, but it's true. Widespread access to home ownership allows families to build savings over time. Those savings are often used to finance new business startups or as a safety net in a family emergency. Home ownership is tied to retirement security, with millions of Americans hoping to pay off their homes and live on their Social Security. Home ownership creates family wealth, and parents who are able to pay off their homes leave inheritances for their children and their grandchildren that build opportunities across the generations. For families of modest means, home ownership is more than the American dream. It is a key to building a secure economic future. A central feature of the American housing market is the fixed 30-year mortgage. Changes to housing finance that don't support the 30-year fixed mortgage or offer a substitute that will create other ways for people of moderate means to buy homes will cut millions of families out of the housing market. And the consequence will be to accelerate the divide between the very wealthy and everyone else. So, don't get me wrong, I believe that housing finance reform is absolutely necessary. Fannie and Freddie cannot remain in conservatorship indefinitely, and taxpayers should not bear the risk of nearly all of the $10 trillion housing finance market. Not everyone needs or wants a 30-year fixed rate mortgage, but even so, we must act carefully. If we get housing finance reform wrong, the impact will be felt throughout America's middle class. It's no politics here, it's just getting the focus hard on getting housing finance right. Now, perhaps the first step in designing a new housing finance system is understanding what went wrong with the old system. If we understand that, then we can steer clear of some of the same old mistakes. While the crisis was massive and painful, and its impact continues to weigh on middle-class families even today, its underlying cause, I believe, was fairly clear. According to the Financial Crisis Inquiry Commission, the crisis was triggered by the rapid growth of the origination and securitization of subprime loans in the private label market. There were other contributing factors, of course, but fundamentally, the crisis started one lousy mortgage at a time. The GSEs made significant mistakes that cost taxpayers dearly, but those mistakes were not the underlying cause of the crisis. We now have some good independent research on this from the Federal Reserve Bank of St. Louis. Their careful analysis shows that despite claims to the contrary, Fannie and Freddie's affordable housing goals were not to blame, not even a little bit, for the rapid increase in subprime originations. Although Fannie and Freddie purchased securities backed by subprime loans, and some of those purchases helped fulfill their affordable housing goals, the Fed economists, the St. Louis Fed economists, found that the housing goals, I want to underline this, had no impact on either the number of subprime loans originated or the price of those loans in the private label market. Affordable housing goals have been scapegoated by those who have been itching to get rid of those goals for a long time for political reasons, but I think it's time to drop that red herring. In fact, the data are pretty clear about what went wrong. Fannie and Freddie's mistakes resulted from their attempt to increase profits for their private shareholders. As they saw private market participants making money hand over fist, the GSEs dramatically increased their leverage and purchased billions in supposedly low-risk private label mortgage-backed securities. At the same time, they sought to generate more fees by lowering their underwriting standards and purchasing Alt-A loans, loans to borrowers who are categorized as prime, but who were not required to provide any income documentation. So when the payments on these mortgages shot up and housing prices stagnated, borrowers were caught. They couldn't make the payments and they couldn't refinance to lower cost mortgages. So the foreclosures started piling up, and Fannie and Freddie did not have enough capital to absorb the losses. Now, I think the history here provides a valuable lesson. It is worth every discussion about housing finance is to start there, because it reminds us now how we have to aim. At its core, the story of the housing crisis is a story of moral hazard for all three players: for the originators, for the private label issuers in the secondary market, and for Fannie and Freddie. In the private label market, originators had too little incentive to assess whether subprime borrowers could actually repay their loans, because the originators immediately sold these mortgages into the secondary market, where they became somebody else's problem. And for their part, the private label issuers had too little incentive to verify the quality of the loans they purchased, because they could pool those mortgages, slice them up, and sell them off to obtain favorable credit ratings for even the riskiest tranches, pretending that those loan problems had magically disappeared. As for Fannie and Freddie, they had too little incentive to manage their risks, because they knew they would reap the profits if things went well, and everyone knew that the government would step in and bail them out if things went badly. So the question becomes, how do we address the moral hazard problems while preserving the good aspects of the housing finance system? I think that's the heart of the whole thing that we're trying to solve here. And let's face it, there is no single silver bullet to fix this problem. But here are some ideas that I just want to throw out, because you all will be talking all day, and I don't get to stay, but I hope at least the ideas get to stay for a little while. So the first one is, I think it is critical to replace the implicit guarantee for Fannie and Freddie that existed leading up to the crisis with an explicit privately financed guarantee for whatever entity or entities replace Fannie and Freddie. The guarantee should be expressly limited and conditioned on private capital occupying a significant first loss position. But the key point is, it must be there. We have to be realistic. The housing market is so large and so important to the American economy, and so important to families across this country, that there is no plausible scenario in which the government does not guarantee at least a portion of it. There will always be a government guarantee, and in my view, an explicit guarantee is vastly superior to an implicit guarantee. An explicit guarantee is like any other insurance policy. Customers pay for the insurance, and it can be expressly limited. Equally important, an explicit guarantee will provide the assurance the market needs to make those 30-year fixed-rate mortgages, which I think is critical. Second, huge servicer and trustee problems that emerged during the crisis and its aftermath, problems that exacerbated the depth of the financial crisis. Servicers were supposed to act in the best interest of their investors, but because of certain financial incentives, such as holding second liens on mortgages they serviced, or receiving larger fees for foreclosure for loan modifications, many servicers failed to pursue loan modifications that would have benefited both the homeowners and the investors. Because they owed no formal fiduciary duty to investors, the trustees were often lax in supervising the servicers. So, in order to produce a more stable housing market, I think it is critically important to solve the servicer problem. We need to put that right up front. Aligning the interests of servicers, trustees, and investors in both the guaranteed and the private label securities market will increase beneficial loan modifications and reduce unnecessary foreclosures. And those changes can be the difference between a short, mild downturn and a lengthy nationwide crisis. We learned that lesson the hard way, and shame on us if we don't account for it in the next round of housing finance. Third, the new system must not exacerbate the too-big-to-fail problem by increasing the competitive advantages that large institutions have over everyone else. The primary market is already dominated by a handful of large players. It would be easy to create a system that allows these large players to translate their primary market dominance into the secondary market, which in turn would increase their advantages in the primary market. The reform should not crowd out smaller financial institutions. A housing market dominated by a handful of too-big-to-fail institutions would reduce access to mortgages in poorer areas, in rural areas, and we can't do that. It would also increase systemic risk, and I believe it would reduce innovation and customization in the private market. So any future housing finance system must ensure not only that smaller lenders can sell their loans into the secondary market, but also that they can do so at competitive rates that will permit them to stay viable. And fourth, my last idea, and then I'll quit. I think this is the most important one of all. The portion of the secondary market that is government guaranteed must serve the entire primary market. If the good faith of the American taxpayer is going to be used to back up the housing market, then that housing finance has to be open to all potential buyers. Without that option, significant parts of this country will stagnate economically, and those who live there will be cut out of the benefits of home ownership. Either collectively or individually, the entities that enjoy the benefits of a government guarantee should have a clear and enforceable duty to serve the entire primary market. So I will wrap this up by saying what we all know. The $10 trillion housing market affects every American, and its current form is unsustainable. We need reform, but it must be targeted reform that seeks to preserve access to home ownership. If we keep that in mind as we consider housing finance reform, if we approach the task with seriousness and a hard look at data and at facts, then I believe we can temper the boom-bust cycle of the housing finance market and help families build real wealth. I want to thank you all for the work that you will do here today. I want to thank you as I look around the room at the work you have already done and how it has informed the conversations about refinancing and restructuring the housing finance industry. Many of you know there's already been a bill reported out of the Banking Committee on Housing Finance Reform. There's already a bill through the House. Right now, we're continuing negotiations on that bill. Even though it's been reported out of committee, it's not a bill, it's a bill I voted against, and it's a bill that I certainly would put as much energy as I can in its current form to stopping, because I believe it's wrong. But it doesn't mean that I've given up on housing finance reform or that others have. You could not find a more timely moment to discuss the issues about how to shape housing finance reform. We've spent a year and a half now in the United States Senate in the Banking Committee, having one hearing after another hearing after another hearing. I've been at all of them, I believe, and asked questions, done my reading. But it really is the case now. We've got some of the pieces, we've got the shape, we understand the importance of the government guarantee, we understand the importance of the first loss position, but getting the rest of the pieces so they really work, and so they work for this economy, so they work for families across the country, is absolutely critical. So I want to thank you for your work here today. I want to thank Adam for picking such a terrific topic and bringing everyone together to talk about this. And I'm looking forward to hearing about your conversations, about your ideas, about your conclusions. I know Adam will email me at the end of the day. All right, good. So thank you.